Let's remind our listeners that a month ago when we recorded this video, Marcos said how the market had not had any 1% moves the entire year.
It was 2%, but no big deal.
Okay, 2%. I wasn't listening very carefully. Since April 1st, month of April, about 20 business days. By my count, we've had 12 days of 1% or higher.
It's incredible. Let's start the episode. We can start it there. How's that sound? Welcome to episode 67 of Talk Your Chart. I am Marco Segrera, along with my co-host Brett Horowitz. We are recording on May 6th. Happy belated Cinco de Mayo, 9:40 a.m. So whatever has hit the Twitterverse, we don't know about it yet. So everything with a grain of salt, as always. All right, let's get to the charts. First one up for me, I think I went tariffs. Yeah, I did. So, Brett, how often you get the question, what are we going to do about tariffs? And the response that I usually like to lead with is, well, we're really not going to do anything. I might buy a car before the end of the year if my son needs one, but we're going to be counting on the companies that we own and the portfolios that we manage to handle those tariffs and plan around those tariffs, because that's what they're in the business of doing. And this first chart from Torsten Slok out of Apollo is telling us that, well, here's what they're doing. You're going to pay more. So they're passing the cost increases through the customers, followed by number two, absorbing cost increases internally. This doesn't come as a surprise to you, I would imagine.
No, I think, look, if the tariffs stay in place, it's a big if, because clearly there's chatter going on to try to reduce the tariffs or eliminate the tariffs. This will be the outcome. But I think when we talk about the companies in the stock market, we talk about the S&P 500, companies will find a way to make money, whether that's passing on the cost, whether that's getting more efficient, whether that's absorbing them, whether that's people buying a lesser version of what they had before, or as Trump said, buying 2 toys instead of 40. Like, people are going to spend money, companies will keep making money. That's why you own stocks. They adapt. That's what companies do.
Yeah, I agree. And then to kind of line this up with the real quick inflation point, I think there's a difference between inflation and perhaps what you might consider a luxury good just being more expensive. If food and oil prices are kind of getting unwieldy and increasing materially in price, that's going to be impactful for everyone. That's not what we're seeing. We're more concerned, at least given like the current state of play, and that can change obviously by the time we're done recording this, is your iPhone might cost more. And I don't know if that's an inflationary environment or that's just a kind of reordering of what we prioritize and how we pay for things. So just a thought as people are also kind of fearful about inflation becoming a thing again. And I will roll that into initial and continuing unemployment claims. Because I don't remember what our predictions were, Brett, for recession this year. I probably said no. I know I was on the yes camp in 2022, I think, or maybe 23. It's just hard to have a recession if people don't lose their jobs. And there's just no signs of that happening at the moment. Again, that could change. Maybe if the tariffs stay online, that's when all the CEOs say, well, we were just waiting for it to be a certainty and now we're chopping half of our workforce. But without that happening, I just don't see a recession coming into play.
Well, you did say yes for 2025, probably because I said no, and you said I'll just take the other side. But agree. Now, remember, as you mentioned, every time this is backward looking, so it doesn't say what's going to happen going forward. We know a lot of government workers are currently getting paid temporarily while they go through this transition period and ultimately might lose their job in 6 months, so there might be more unemployment then. But as we've transitioned our economy over the last 40 years from manufacturing to technology and other things, people have found a way to find a different job, right? So I'm not saying it's going to be easy, but if you have a government job or another job, hopefully there's a job out there for you. I mean, people are finding it.
Yeah, and the other thing that did trigger recently, on top of the fact that we had a negative GDP print, was the SAM rule, which is something that tracks the rate of change of the unemployment. And it triggered, I want to say, a month or two ago. And what that usually does tell you, and it might have been even earlier than that, it might have been closer to February, that usually tells you, hey, we're in a recession. So it's a concurrent indicator. If you want to Google it, it's kind of interesting, SAHM, SAM rule. She's an economist. So who knows, but she also said herself that it might have been a false trigger this time around because the data is all off.
The recession predictions are all over the place, though. You've got people screaming 90% chance, you've got others saying 20% chance. I'm sure that'll change if we get through this 90-day period with or without a change to the tariff policy. But like, no one really knows. The numbers are all over the place if we have one or don't have one, because you just don't know what people are going to do going forward. You don't know how they're going to react to this information that's coming out.
So I thought this was awesome, and this I got from our friend Eddie Ardeni. These are the last four covers of The Economist, and needless to say, they are pessimistic in nature. The Economist, similar to the Madden curse, if you're not familiar with the Madden curse, it basically tells you if you're on the cover of the Madden football game, you're going to have a terrible next few years. Why is that the case? Because usually if you're on the cover of Madden, you've had an awesome run to get yourself to the cover of Madden, so there's a reversion to the mean. Usually when The Economist is as pessimistic as it is showing here, it's actually a contrarian indicator, and I'm going to couple that, Brett Horowitz, with a sentiment index survey that is coming in at 52.2, which is worse than what we saw in the Great Financial Crisis and approaching what we saw in June of 2022 with 50-year high inflation readings. Are we ready to buy?
I'm yawning with this statistic. Here's why. A couple
Tell
things. And it's not on you. It's not on you. I think, A, The Economist might be pessimistic because there's a Republican in the White House. That could be part of it. I think number two, fear sells. We know that. But let's talk about consumer confidence going back to 2022 when it was also very low. So at that point, the sentiment fell sharply. And you know what? Consumers kept spending then. I was reading that Bank of America said even after Liberation Day in April, credit card spending was 3% higher than it was than the year earlier. So while there may be places where people are not spending money, they are still spending it. So they can say they're not confident, but they're still spending as if they are confident.
Well, look, any sentiment survey is always going to be soft data that doesn't matter because it's not tell me how you feel, it's show me what you're doing. And yes, I agree with you. Show me what you're doing. But I look at this and I'm looking at all these signals. If you get this type of reading, that bodes well for market performance over the next 12 months. There's just no two ways about that. And I think your point about spending is obviously true, but it's because everyone has a job. Everyone's saying things are terrible while they're eating a filet mignon at their local steakhouse. So yeah, show me that things are terrible, but it could happen.
I'm looking to see when sales of spam spike. That's when I know this is all going downhill.
Okay, let's look at, what do I have next? Okay, income. So, and this is across political spectrums of everyone kind of coming into the office saying, everything's terrible, let's go back to the way it was, and that's whoever's coming into the office. Everything's so bad now, let's go back to the way it was, everything's so bad now, let's go back to the way it was. And I think you've heard of this idea of the hollowing out of the middle class. I think this chart from the Census Bureau does a good job of showing us that the middle class has leaked into the high income class, and that low income class has only gotten smaller. So when you look at this, Brett, does it make you optimistic or pessimistic?
I think every president who comes into office who is pitching to make themselves a president uses all the data they can find to make the world look less rosy than it is. I think, as we've said in the past, you've got to be an optimist to be in this business. You've got to be an optimist if you want to be an investor. And over time, we've seen the country. I mean, there's lots of statistics that things are worse, but for financial-wise, I think you could say that people are in much better shape than they were a long time ago.
Yeah, I didn't even put literacy and hunger on this, but everyone knows that those two things are also better. So maybe we wake up with a smile a little bit. Not to say there aren't folks suffering, because obviously that's never going to be a zero. But I had never seen this chart, to be very honest with you, and I thought it was pretty telling.
Well, there was a book I read, I don't know, a few years ago, we talked about it.
Factfulness.
Yeah, factfulness, right. Where it was, plane crashes are down. People only have to have one or two kids now to have one or two healthy babies, where before you'd have like 5 kids just to have like one or two healthy. Like, there's thousands of those statistics out there that say we're in a much better place than we were 30, 40, 100 years ago. But if you want to look for things that are negative, you'll find them.
Yeah, you will. Median income, real median personal income in the U.S. is also just off of all-time highs at $42,000. That was $28,000 in 1974. What is that annualized? Outpacing inflation by a mile. So last thing, I spent my entire 15-minute drive today talking to Gemini because I've never done it and I wanted to. I had a conversation with this AI thing and I mixed up words. I said, wait, don't think about that. Don't do this. And I carried a conversation for the 15 minutes it took me from dropping off my daughter to here. The amount of computing power that I just used, I have no idea how much it was, but it's way more than streaming a song or a podcast on Spotify. This is a chart of how much money these hyperscalers, Alphabet, Amazon, Meta, Microsoft are going to be spending on building out this infrastructure. Is it going to be too much? I don't think so. I think it's going to be just right. They're going to be spending just shy of 50% of free cash flow on scaling this stuff out.
Okay, so what surprised me, moving on to the next chart, is that institutional money has moved out of stocks this year. Let me give you a statistic that I was surprised to hear. Hedge funds have sold over $1 trillion more shares than they have purchased, even as retail investors have made $50 billion a month in net stock purchases. Vanguard said 97% of investors in the 401k universe that they track did not make a trade in early April after the tariffs came about. About a fifth of investors increased their savings rates. In contrast, hedge funds, clients of Goldman Sachs, sold more stocks on April 3rd and April 4th than any other two-day period in the last 15 years. So what's going on here? Why are hedge funds dumping stocks while retail investors are buying stocks?
It's the smart money, man, right? We're just the dumb ones.
Well, we'll have to see who's smart and who's dumb as we go forward in this. But there's two main reasons that are cited as to why hedge funds are dumping all this money. Number one, they tend to be leveraged. They tend to have borrowed money. So when you're borrowing money and the stocks go down, you either have to pay that money back or you get a margin call or whatever it may be, and you have to sell stocks, unfortunately. The other cases, a lot of them have predetermined limits on how much they can lose before they have to sell. There's a lot of computerized trading, so when it hits a 5% down or a 10% down, they are forced to sell. Whereas the retail investor, I think we would say, was smart, looking at this much more long-term, saying it will come back, it will be okay, I'm going to take advantage of these drops and buy more, just like we did at the company in early April.
Yeah, look, I think it's fair for both of these types of investors to be right, because I would tell you that they're both playing different games. Some people need to open positions and close positions the same day. Our clients don't. So I think this is more noisy than it is insightful. I'm not sure there's a ton of signal from this, other than leverage can force you into situations. And I think that's a lot of what that was. Because while the market didn't fall even up to 20%, 5% days in a row, that's huge vol in just one day worth of trading. Markets are up roughly 3 to 6% since Liberation Day. So was it a good decision or a bad decision from hedge funds? Who the heck knows, right? They could have been forced into it, leverage, no bueno. I don't think we should be getting any type of signal, or at least I'm not, and our clients should not, and investors that are playing the type of game that we think they should be playing shouldn't really learn much from that.
Right. The client says, what are you doing on that day? The answer is nothing. We're going to be buying, and if we need to, if things keep dropping, but we're not trading every single day. That's a loser's game.
Yeah. Don't invest a down payment. It's okay.
So the next chart by our good friend Flavio Landivar, who shared with this, I thought this was great. 3 different charts. We'll go through them briefly because all the headlines are U.S. doesn't manufacture anything anymore. So the first chart is showing sort of our manufacturing payrolls, how many people are working, versus the production, what are we producing? And the statistics are pretty interesting. Basically, in 1940, 39% of workers were in manufacturing. Today, it's 8%. However, output has increased more than 12-fold due to advances in technology, automation, and efficiency. So that's number one. Number two, you say, okay, I get that, but what are we producing? We're still the second largest producer of goods in the world, in China. In fact, we're higher than number 3, Japan, number 4, Germany, number 5, South Korea, all combined. So it's not they're producing nothing, we're just producing less things. While we are producing less toys and t-shirts and cheap things, we're certainly building more advanced things like airplanes, semiconductors, and biotech. And so the third chart basically shows you what is the real manufacturing value of a worker. China is down at $22,000 output per worker, where we're producing $143,000 in output per worker because of our productivity. How about that?
I think this is wonderful. I think we need to make sure we onshore EV production, pharmaceuticals, chips, all that type of stuff. But yeah, I don't think we need to onshore t-shirts.
Yeah, I think, most clients, even if they don't agree with the tariffs, they say, well, we don't want to get in a situation where we can't get access to rare minerals for these semiconductors or to what happened during COVID, whether it was masks or other PPE materials. So, like, there's some important things we need to do, but I'm not sure we're going to go back to producing the cheap stuff here.
Yeah, there's also a ridiculous statistic. Do you know how much the estimated value of the rare earths that we import in the US in 2024?
$5 trillion.
$170 million.
I was close.
Isn't that's basically like a 50 spot for you. $170 million is how much we imported. It's nothing. Our GDP is 30 trillion. It's like that. I don't know what or why, but for everyone out there, $170 million is how much we imported. Maybe it's because we can't. I have no idea, but I thought that was a ridiculous figure.
Okay. So we touched on GDP earlier. So let's
Yes.
talk about this first quarter report that had everyone's eyes going crazy because it was negative. Oh my God, the first negative quarter since I think early 2022, where we had a 1 quarter of negative GDP. The biggest few changes were in the last two columns, federal government and net exports. Federal government, I think it's pretty obvious that that would fall because spending on the government has dropped. Doge and everyone is doing a lot there. And exports dropped because businesses stocked up on inventory ahead of the tariffs, right? If you'd read the news, car dealerships were packed. Businesses were buying as many things as they could before the tariffs went on sale to bring them into the US. That way they would not get hit with the tariffs. And imports obviously are negative to GDP because that's the amount of money that we spend buying foreign-made goods. Without that, you would have had a positive GDP. Consumer spending was still positive. So the headline is, oh my gosh, the world's coming to an end. We're losing, GDP is negative, but that's just importing, and that could get worked out the next few quarters when we use that stocked up inventory to bring that down over time.
Yeah, that change in inventories will also come down, but yes, this is, I like this chart. Yeah, that's it. Most folks are still projecting about a 1.8% growth in GDP for Q2, so we'll see if that changes.
Yeah, again, consumer continues to spend. Consumer spends because they have a job. Consumer spends means businesses make money.
Yeah,
Simple
it's
as
just
that.
not going to matter unless people got to get fired. If you don't get fired, we're going to spend. That's what we do.
Yep.
That's what we do about Horowitz. All right. I know we
Alrighty.
went long and you're really upset about it and you're going to give me a lecture about it, but I loved this episode. So there you go.
Good. Hope people like it too.